Here's a summary of Wells Fargo's Q1 2026 earnings call, designed for clear, spoken delivery. Good morning, everyone. Today we're reviewing Wells Fargo's first quarter 2026 financial results. Key financial highlights for Q1 2026. Wells Fargo demonstrated positive momentum in the first quarter of 2026, with diluted earnings per share increasing by 15% year-over-year. This was underpinned by revenue growth of 6%, fueled by a 5% rise in net interest income and an 8% increase in non-interest income. Loan growth was robust, with loans growing 11% and deposits up 7% compared to the prior year. Pre-tax, pre-provision profit saw a healthy 14% increase year-over-year. Credit performance remained strong, with the net charge-off ratio stable at 45 basis points. The company also returned significant capital to shareholders, with $5.4 billion returned, including $4 billion in common stock repurchases. CEO's remarks. Charles Scharf. Our CEO, Charles Scharf, highlighted the positive impacts of the company's strategic investments, noting broad-based revenue growth across all operating segments. He expressed pride in closing the final outstanding consent order, marking a significant milestone in operational improvement. With these foundational issues behind them, the focus is now squarely on accelerating growth and improving returns. Key strategic priorities and their progress include consumer franchise. Launch of new travel-focused reward credit cards has driven higher purchase volume and loan balances, with new account growth up nearly 60% year-over-year. The auto business also saw originations more than double. While momentum in new primary checking accounts is encouraging, it's not yet at the desired pace. Digital engagement continues to grow, with mobile active users surpassing 33 million and over 1 billion customer interactions with their AI assistant, Fargo. Wealth and investment management. Client assets grew 11% to $2.2 trillion, and net asset flows accelerated to their highest level in over a decade. Commercial businesses. Commercial banking is seeing early success from hiring coverage bankers, with loan and deposit growth accelerating. The corporate and investment bank experienced strong revenue growth in both banking and markets, with a solid pipeline for investment banking activities. Simplification efforts. The company completed the sale of its railcar leasing business, substantially completing its efforts to refocus and simplify by exiting or selling 12 businesses since 2019. Economic and customer outlook. Mr. Scharf described the U.S. labor market as cooling in an orderly but uneven fashion, with the consumer remaining resilient in aggregate but increasingly bifurcated. Higher-income households are benefiting from elevated asset prices, while lower-income households face more stress from higher interest rates and energy prices. Despite this, customer financial health remains strong. The company anticipates that higher energy prices will eventually impact consumer and business spending, but believes Wells Fargo is well-positioned to navigate various economic scenarios due to strong credit management. Regulatory developments. Regarding the recently proposed capital rules, Wells Fargo views them as a constructive step. Based on current balance sheet composition, they estimate a potential decrease of approximately 7% in risk-weighted assets. They also expect to remain around a 1.5% GSIB surcharge for the foreseeable future. CFO's remarks. Michael Santomassimo. The CFO, Michael Santomassimo, provided a deeper dive into the financial results and outlook. Key financial metrics and performance. Net interest income, NII, increased 5% year-over-year, but declined 2% sequentially, largely due to fewer days in the quarter and the impact of prior rate cuts on floating-rate loans. The net interest margin, NIM, declined 13 basis points sequentially, primarily driven by balance sheet growth in the markets business, increased interest-bearing deposits, and lower interest rates. Additional margin compression is expected in the next quarter. Loan growth. Strong performance with period-end loan balances growing 11% year-over-year to exceed $1 trillion for the first time since 2020. Average loans increased 10% year-over-year, driven by commercial and industrial loans and consumer portfolios, excluding residential mortgage. Financials except banks. Loan portfolio. This segment totals approximately $210 billion, 21% of total loans. The company emphasized its deep understanding of the collateral, client diversification, and structural protections within this portfolio, expressing comfort with the risk-return profile. Credit quality. Commercial credit performance remains strong. Consumer net loan charge-offs increased modestly quarter-over-quarter, reflecting seasonal credit card losses, but declined year-over-year. Non-performing assets remain stable. Capital and liquidity. CET1 ratio was a strong 10.3%, within their target range and well above regulatory minimums. Operating segment performance. Consumer banking and lending. Revenue up 9% year-over-year, driven by deposit and loan balance growth. Credit card revenue grew 5%, and auto revenue increased 24% due to higher loan balances. Home lending revenue declined 9%. Commercial banking. Revenue increased 7% year-over-year, with loan growth of 4%. Corporate and investment banking. Banking revenue up 11%, and markets revenue grew 19% year-over-year. Wealth and investment management. Revenue increased 14% year-over-year, driven by growth in asset-based fees and higher net interest income. 2026 outlook. Net interest income, NII guidance remains $50 billion, plus or minus, for 2026. They expect NII to grow over the course of the year, supported by mid-single-digit average loan growth and deposit growth. The CFO noted that fewer anticipated rate cuts by the Federal Reserve would be a positive for NII. Markets-related NII is expected to be around $2 billion. Expenses. 2026 non-interest expense guidance remains unchanged at approximately $55.7 billion. The increase year-over-year is primarily driven by revenue-related expenses in wealth management and investments in technology and advertising. Management's forecasts for future quarters. Management anticipates continued margin compression in the near term, primarily driven by the growth of the market's balance sheet and increasing interest-bearing deposits. However, they expect this to moderate as other parts of the balance sheet grow. Loan growth is expected to remain strong, potentially exceeding mid-single-digit expectations. The company anticipates continued growth across its businesses, contributing to increasing returns. Significant risk factors. Economic volatility, continued macro and geopolitical uncertainty, and the evolving impact of higher commodity prices could lead to market volatility. Consumer stress. While aggregate consumer health is strong, there are signs of rising stress for less affluent consumers due to higher interest rates and energy prices. Interest rate environment. Changes in interest rate expectations, particularly the number and timing of Federal Reserve cuts, can impact net interest income and deposit mix. Regulatory environment. The finalization and implementation of new capital rules, while viewed as constructive, will require ongoing adaptation. Lowlights. Sequential NIM compression. The net interest margin experienced sequential compression, influenced by balance sheet mix and interest rate movements. Consumer checking account growth pace. While improving, the growth rate of new primary checking accounts is not yet at the company's desired pace. Impact of higher energy prices. Potential headwinds from rising energy prices on consumer and business spending. Most important statements. CEO Charles Scharf. With this work behind us, we are now focusing more fully on accelerating growth and improving returns. And we have clear plans in place and are focused on driving continued organic growth and increasing returns across the franchise using our broad set of capabilities. CFO Michael Santomassimo. We expect additional margin compression next quarter, and we will reevaluate what that is and how big a buffer we think we need at that point in time, in reference to capital requirements post-finalization of capital rules. In summary, Wells Fargo delivered a solid first quarter with strong revenue and earnings growth, driven by broad-based improvements across its businesses. While facing some near-term margin pressures and economic uncertainties, the company is confident in its strategic direction, its ability to execute on growth initiatives, and its path towards improving profitability and returns.